Okay, so let me start with this slide first. Here we can see the performance of the sectors in the PSEI for this year. And clearly, we can see that the financial sector is the
Mhm.
weakest among all the other sectors. Down 40% year to date, down 30% since the start of March. And very, very noteworthy for me is that since the March low, March 19 low of the index, the financial sector has only rallied by an average of 2% versus the rest of the rest of the market, which rallied over 20%. So um, yeah, so for me, it's really about the uncertainty that's covering the banks. I know that, and I'm sure it's evident from April's presentation a while ago that the uncertainty is really across the board, right? It's not only specific to banks, but what's special about banks is that they're ultimately tied to all the sectors of the economy. So if, for example, April mentioned a while ago, like we're bearish on, let's say, consumer discretionary. um, let's say we're bearish on the, let's say, tourism sector, or even if you're bearish on the remittances, then if you really think about it, the banks are ultimately linked to all of those things, right?
Mhm.
And I think that uncertainty is really weighing down on the banking sector. Later on, we'll be talking more about that, and to see if we can do something about it, right? But before we go into that, I just like to give a brief outline of what I'm going to talk about for today. In the interest of trying to be as objective as I can, let me try to divide the discussion into the positives and the negatives, right? So for us, the biggest concerns for the banks are the following. Number one is obviously spike in NPLs and consequently the credit cost. Slowdown in loan demand, not only for this year but for the years to come potentially, right? And trading losses, any potential trading losses going forward. Nevertheless, let's also mention the mitigants that we have right now. Number one of those would be very supportive policies from the BSP. So April has mentioned something with that a while ago already, but more into that later. Strong capital adequacy for the banks, and not only strong on an absolute basis, but relative to the other countries also, and very undemanding valuations. So I guess that's one upside of not rallying since the bottom, is that banks have remained cheap, whereas the other sectors have already rallied, right? So very undemanding valuations. Okay, now let's talk about NPLs first. Of course, it's only fair for me to start with saying that it's really too early to be certain about anything about the banks. I guess one if you look at it, for example, if you look at the first quarter earnings of the banks, for example, core earnings. What I mean by core is the net interest income, your fees, your regular OPEX, not including provisions. So the core operations of the bank seem to be is actually still growing, right? And the thing is that the impact of the pandemic on the banks would come at a latter period, no? So later compared to the other sectors. Because if you think about it, even with the imposition of the ECQ in mid-March, the banks are still continuing their operations, meaning they're still earning interest on your loans, right? And and um, and if you really think about it, the companies also won't really pay off the debt because we're in ECQ. In fact, they might not be able to pay. That's the risk that we're going to talk about. But what my
Mhm.
point here is that it really is too early, particularly for the banks, because the impact of the pandemic would be felt uh, several quarters or years down the road, right? But so having said that, here are base case assumptions. No, For this year, we're looking at NPLs for the industry on average to double from about 2% in gross NPLs to 4% for the year. Um, and just to share where we got this number, if you recall in the Asian financial crisis, if you look at, for example, from 1997 to 1998, at that time NPLs also doubled. I think a bit higher than double, from about less than 5% in 1997 to a little over 10% in 1998. So just as a base case, we're looking at a similar, doubling in NPLs for this year. This was also shared by BPI in its earnings briefing a few weeks ago. They share that they see their own, earnings, sorry, NPLs to double this year, right? And so that's our base case assumption. And just to complete the comparison to the Asian financial crisis, recall that during the AFC, NPLs rose from 3% in 1996 to a peak of 17% in 2001. So two things to note here. Number one is the magnitude of the increase, right? So very, very sharp increase, right? From 3% to 17%. And number two, the length of time it took for the NPLs to peak. So 4 or 5 years for the NPLs to peak, right? In our base case, we think this is much more, hopefully we're right. This should be much more tempered and more temporary also. Um, just from my personal belief, at the underlying reason for the slowdown, or at least for the spike in NPLs, is very, very external, right? Compared to the AFC, and the fact that what's a positive thing that I've noticed is that when you talk to the banks, all of them seem to remember the Asian financial crisis. No? So that's a very good thing for me, because at least we can still learn from from the country's mistakes in the past. So as April mentioned, for example, a while ago, monetary policy wise, we're much better now compared to the AFC. So maybe, yeah. So I'm cautiously optimistic that this should be much less of an impact compared to 1996, 1997, right? So some other things to note, just to finish the comparison with the AFC. Um, Credit rating of the banks and of the country actually is much better now compared to then, right? If you look at the lending rate, also much better now compared to 1997. We're doing at 16% then, now just about 7.1%. And not only the absolute amount, but the direction. So, as again, we already talked about this a while ago. At that time, interest rates increased during the financial crisis, but now it seems like where there's a chance that interest rates could hold, or even go lower. Um, and this is true not only for the Philippines actually, but globally, right? Because of all the aggressiveness of the central banks worldwide, and also debt to GDP levels much lower than before. And even with the, as April mentioned a while ago, yeah, GDP, let's say debt to GDP go up to 50, 52%, then I think we're still relatively okay. So I guess what I'm trying to say is that I don't think a 1997 level impact is likely at this point. But of course, it doesn't really tell us anything, because it could still be very bad, right? Okay, so looking more specifically to each bank, here we just get, provided the breakdown of the loan portfolio of the banks in our coverage list. Uh, as you can see, majority of the bank's portfolio is on the corporate side, which is a good thing. We're looking at, our concern is really, at least for this cycle, and then for any cycle in general, would be the consumer portfolio and the SME. Microfinance also, but microfinance is a very small part of the bank's portfolio at the moment. So we can can skip that for now. Um, so I'd like just to highlight that there's a trend here that on the left side of the chart that the smaller the bank, the bigger the exposure in general to the consumer loans, right? And going to the breakdown of the consumer portfolio, we're particularly looking at the more sensitive ones like auto and credit cards. We think that these are more sensitive compared to mortgage because in just the order of the order of the default, right? You probably would default on your mortgage last, right? And yeah, so hopefully it's also very clear that as you go smaller as a bank, the exposure generally increases. Of course, with several exceptions. No? So let me just highlight some of those notable points, right? So just going back to the left side first, um, PNB is particularly high in corporate loans, right? Security Bank is high on consumer loans at 26%. RCBC also very high at at SMEs, sorry. So one of the highest in the sector, right? And then Union Bank and East West are both very high also in consumer loans, right? Um, in terms of the breakdown of the consumer portfolio, some interesting things. If we look at auto loans, for example, Metrobank is particularly sensitive to this with its partnership, obviously, with Toyota. Security Bank also has a high exposure in auto loans. RCBC and East West Bank, very very high in auto loans. Um, the purple line, the purple bar here is your salary loans, teacher salary loans. No, so that's what it is. Yeah, there. So generally speaking, the smaller the size of the bank, the more exposure to consumer loans, with some exceptions. Now let's look at the NPL levels of each bank and the coverage ratio. Again, so the blue bars here are your NPL levels, gross NPL levels. You can sort of imagine it trending up as you go from the biggest bank to the smallest bank again. And the NPL cover, the inverse of that, generally speaking, it's going down with some few exceptions. No? So what are those exceptions? PNB it has a high NPL for its relatively low consumer exposure for whatever reason. Coverage is also relatively low. Security Bank has a relatively high coverage. Um, despite and a relatively low NPL level despite its high consumer portfolio. No? So those are the exceptions, but in general, you can see a trend here. No? NPL cover going down with smaller size, NPL levels going up with smaller size, right? So yeah. Uh, so what we did for our forecast is that we considered the consumer exposure for each bank, the consumer, the level of exposure for the consumer segment, and their current NPL levels as a benchmark for our credit cost, no? Because ultimately this is what will affect earnings for this year. No? Would be the provisioning for the banks, right? So these are our increase for the banks in our coverage list, right? You can notice that in general, the smaller the bank, the less the increase, right? Uh, and on average, our credit cost assumptions, we already assume about a 25% increase. Sorry, the, okay, the average increase in credit cost, okay, translates to about 25% of additional NPLs. Again, recall a while ago, our base case is for NPLs to double this year. So we're assuming roughly 25% of the increase we're gonna have to provision for this year, and that also translates to about 2% of consumer loans. So the bigger the consumer loans, the bigger the NPLs, the higher the provisioning that we're doing. Yeah, and just to give to provide more, I guess, support for our assumptions, recall. So two things first. Now, recall that in the Asian financial crisis, only one third of the NPLs were ultimately written off, right? So it doesn't mean that if your NPL spike from, let's say, 2 to 5%, you have to provide 3%, all the 3%. So you don't need to do that. And another thing that's also noteworthy for us is that BSP has allowed a staggered booking of provisioning over 5 years. No? Of course, subject to approval, but yeah. So the banks could theoretically spread out their provisioning for the next 5 years. Right, so those are the mitigating factors, no, for the credit cost. Note here before we leave the page, the numbers here reflect the increase in credit cost, not the overall amount. These are just the increase from our original assumption in credit cost. Okay, so looking at first quarter 2020, what has happened so far? Here we can see the red bars here. The red bars here is the provisioning for the first quarter. The gray bar is the annualized provisioning for the whole year, and the red dot is our target for the year. So as you can see, most of the banks that we cover have aggressively provisioned in the first quarter. No? So the annualized is much higher than our increased forecast, if you can see, with the exception of maybe BDO and China Bank. So BDO and China Bank, for whatever reason, bookings for the first quarter were relatively low compared to the other banks and compared to our forecast also. On average, also just to give some color on the provisioning for the first half, I believe that it's more generally very proactive rather than reactive for the banks for the first quarter. Uh, Mostly, the provisioning is just general provisioning, so they you know they don't see like specific accounts defaulting yet, right? I'll explain more of that later on. But so these are more general provisioning, and I think the mentality or the mindset of the banks is, let's front load provisions while earnings are still good. Later, I'll show also that the trading gains for the banks in the first quarter were particularly good also. So maybe they took that opportunity to book provisioning, right? So that when earnings start to get hit, maybe as early as the second quarter, then they don't have to provide as much. And yeah, so Metrobank shared on the also that they believe that the earlier that you book provisions and the more aggressively that you book provisions early on, then the sooner you can be more you can go back to normalcy or to be more aggressive going forward, if you already have that buffer going forward, right? So the thing to note here is that the banks all mentioned that the ECQ, at least one of the negative unintended consequence of the ECQ, is the banks cannot see the loan portfolio that are at risk in non-performing, in defaulting. No? So because of the ECQ, obviously the payments to the principal interest payments on the loan are deferred, right? So they cannot see which companies will be able to pay back or not. So very limited visibility because of this ECQ. All of them mentioned that we can see more visibility. We can have more visibility only after we lift the ECQ, and companies are allowed to go back to their operations and to servicing their loans. Okay, so again, just to look at first quarter NPLs, just to give you an idea, as you can see, generally minimal increase in 1Q. Um, oh yeah, if you think about it, this makes sense because again, ECQ, and again, NPLs, the general definition is 90 days not non paying. So Yeah, this is very reasonable. Okay. Now let's look at the second risk for the banks. It is the slowdown in loan demand. Ultimately, we've always believed that the bank's loan portfolio is tied to GDP growth, although the relationship is not as the impact is not as fast, but ultimately it will be tied to GDP growth, maybe with some delay, right? So for this year, we already cut our this year and next year actually, we already cut our loan forecast from an average of let's say double-digit growth this year and next year to about 5% growth this year and around 8% growth next year. No? So low to mid single digit growth forecast for 2020. So this is consistent with the bank's outlook. Right? When we talk to the banks, this is consistent with their expectations for the year. Uh, Looking at the first quarter again, just to see where we're at. The red dot again represents our target for the year in terms of loan growth, and the blue bar is the first quarter loan growth. You can see that most of the banks actually did very well in the first quarter still, so very minimal impact yet, as I was mentioning a while ago. So we can't feel the impact of the pandemic yet. At least that's my view, right? We can probably see that in the coming quarters. Okay, and anecdotally, the banks also shared that the financial system seems to be still doing okay, still seems to be working even during the ECQ. So first point here is that they mentioned that there still continues to be loan releases for corporates, for the big corporates. They don't have any issues there. Obviously, for if you're affected if you're directly affected with the pandemic, um, obviously you won't be able to easily get out new loans, but in general there's still some loan releases for corporates. uh, Interest rates, they mentioned that interest rates came down after the initial spike. Later we can see this also, right? So this is very good, at least in my opinion. Again, if you recall, April mentioned a while ago that in the Asian financial crisis, interest rates increased, right? Because of the tightness in liquidity. So this is definitely a good sign. And then yeah, so BPI anecdotally shared. So lending froze for a short time after the ECQ, but then the BSB successfully stepped in. So again, we'll be talking about more into that later on. But personally, I'm very happy with the aggressiveness of the BSP in terms of the monetary policies. So sharing April's view a while ago, right? So this has allowed the system to, at least for now, work as intended. Right? Okay, last concern is the potential trading losses for the year. Uh, but these are just but actually this is one of our concerns like back in March, but now it seems less and less of a concern for different reasons. Now, first one, banks have recently relied less and less on trading income. So I just put in here the 3-year average uh, percentage of revenues coming from trading income for each of the bank. And so you see very, very small figure with the exception of some banks. For example, let's say Union Bank, Security Bank, even Metro Bank to some extent. But in general, very low reliance on trading gains. And and very interestingly enough, no, this was certainly unexpected, at least on my part. Again, after the initial spike here, right, interest rates for the government bonds fell significantly, to about 3% currently. So in fact, if you look at the first quarter, again, I mentioned this already a while ago, all banks except for BDO and China Bank reported huge trading gains, significant trading gains. And going forward, let's say interest rates do spike. Let's say for whatever reasons, interest rates spike back up to 5, 6, 7%. Then one mitigating factor, just to note, I'm sure you already know also, BSP has allowed the reclassification of securities, investment securities from FBOCI to FBTPL. and FVTPL to HTC. So this effectively removes, if the banks choose to do so, removes a mark-to-market risk for the banks. Okay. Uh, so let's again go back to first quarter and just to look at trade provisioning side by side with trading gains. No? So you can notice several things here. Again, I already mentioned trading gains during the first quarter was significant for all banks except for BDO and China Bank. Just to note, the BDO figure here is, I'm sure you also know that already, is largely weighed down by the mark-to-market losses of its BDO Life subsidiary. And in fact, this 4.5 billion is largely net neutral in terms of the bottom line because it's offset by lower policy liabilities for its life insurance business. Right, so completely offset. Right. Some other things to note, you can see a general relationship, correlation between the amount of trading gains that you book and the provisionings that you booked for the first quarter. So again, we felt that banks trading gains, the banks use the high trading gains to soften the drag of the provisioning in the first quarter, right? And what's important to note here is that with interest rates going down even further after the end of March, then there's certainly more opportunities for trading gains for the rest of the year. So if for whatever reason they need to provide more, they could always, book more trading gains to soften the blow to earnings. Okay. So going forward, these are our estimates, revisions for earnings estimates for this year. You can see the drop the drop versus our original forecast is about 20%. It's more or less consistent across the board after adjusting for the base effect. There are some base effects going on here with Metro Bank, low base for 2019 in earnings, Security Bank, Union Bank. I won't go into much detail anymore, but if you normalize for the base, adjust for those base effects, the cut is generally uniform. But note, however, earnings seems to have a better quality for the bigger banks. What do I mean by this? For smaller banks, there seems to be a steeper rise in provisioning, but offset by higher trading gains as a percentage. No? So if you look at the earnings forecast for this year, roughly uniform across the board, but the quality is better for the bigger banks. Yeah, so moving on to capitalization of banks. Again, banks in general very very healthy, and one thing that we complained about for the last half a decade already is that the BSP has been very conservative when it comes to policies, when it comes to capital adequacy levels, right? The Philippines certainly has one of the highest in the region, and one upside to that is in times like this, then the BSP could scale back a bit more relative to the other countries. So very very strong capital adequacy levels, obviously stronger than both 1997 and 2008. And also, if you look at the leverage, so asset to equity ratio has been going down for the last decade, right? So again, this should at least mitigate a bit the impact of the crisis. And personally, I think this slide is also very important. This is a summary of the regulatory monetary policy measures that the central bank has adopted. And what's very noteworthy to me, at least, is the speed and the comprehensiveness of the actions that the BSP undertook. Right. I think these measures came out as soon as like 1 week after the ECQ. So yeah, so very very fast, very very comprehensive. Right. So I'll just like to note some. Right, everybody obviously already knows about the monetary policy. So number 5, exclusion from past due loan ratio of loans affected of to affected borrowers for a period of 1 year, right? So they have that option to not include them in the NPLs, right? Staggered booking, we already talked about this, for a period of 5 years. Reclassification again, right, to avoid mark-to-market losses. And this one also is particularly important, number 12, inclusion of MSME loans granted after March 15 as part of the reserve requirement. So effectively, this reduces, effectively, the RRR for the banks, because you don't have to, separate cash, actual cash altogether, right? So let's look at the valuations of the banks. No, here I just did the performance, year to date performance of the banks in our coverage list. Uh, Again, generally sell-off is across the board with certain exceptions. What are those exceptions? Number one, Union Bank has performed the best, I guess, has been the most resilient. I think this is mostly just due to the liquidity of the stock, so very illiquid also. So there's really no selling pressure there. So that probably explains the the relatively resilient performance despite its exposure in consumer loans. Um, China Bank, maybe liquidity issues also to a lesser extent, right? Um, BPI has surprised me, actually, not really surprised, but they've performed well, especially since the March 19 low, so they've recovered a lot. And I think this has to do with their, I was personally very satisfied with their earnings briefing a few weeks ago, wherein they seem to be very, very they seem to be on top of the developments, you know, um, and they seem to be very proactive when it comes to dealing with their situation, no? And obviously they have the benefit of having the longest track record, right? So they've performed well also there. Yeah, Security Bank also stands out. It performed the worst, and partly this is because of the MSCI rebalancing, which was announced, I think, a week ago, right? So yeah, down 17% even after the March 19 low of the index. So again, I've mentioned a while ago that yeah, one good thing about the worst performance of the banks is the valuations have become very undemanding already. Right here, I just did a comparison of the relative valuation of the banks. So ROE, y-axis is the ROE, x-axis is the price to book value multiple. Here we did our revised 2020 revised ROE levels with the current price to book value multiples. You can The idea is that you want to be on the top left part of the chart, meaning you have a low multiple with high ROE, right? But of course, personally, I prefer to look at it. I don't want to spend much time here because I prefer to look at the right side, which is where we normalize the ROE for the banks. No? So how did we normalize? Basically, we adjusted for one-off trading gains and for the difference in leverage. No? For the difference in leverage, so the idea is that if, for example, let's say a company like East West, high ROE, but they were able to do this with relatively low capital adequacy levels, versus, let's say, somebody like, let's say, we could use somebody like, let's say, Metrobank. No, Metrobank has relatively low ROE, but it's matched with a high capital adequacy. So if you adjust it, if you normalize the leverage, right? So you see the chart on the right. So again, the idea is you want to be on the top left side. So these are where you get your value plays, right? Yeah. But in general, of course, if we're talking about risk, then the risk, the company, the banks with the less risk exposure would be the ones on your left, no, because of the high ROEs on your right, sorry, because of the high ROEs, and they're often rewarded with the high multiple. Okay. there. So in terms of relative to our to their historical valuations, all of the banks are trading significantly below their historical average, right? Uh, uh, I believe all of the banks are trading two standard deviations below the historical average, right? All banks except BDO and BPI trading below book value, right? So book value, most of them are less than zero point 0.5. Yeah, all except Union Bank offering significant upside to our target. Right, Union Bank may be the reason why there's limited upside because the share price didn't go down as much. Right, so just to conclude everything that I mentioned, again, number one, I think the really the biggest theme for the banks this time is really the uncertainty. So we can't we don't it's really very early, particularly for the banks, because we can't really it's hard to calculate anything with certainty. Um, Personally, I prefer the bigger banks because of their less exposure to the higher risk segments and higher NPL coverage, right? Also, liquidity is also expected to be better for the bigger banks because of their bigger reach and and better quality of deposits, right? And but do note that most banks are already very cheap. Even the smaller banks are very very cheap, right? So ultimately, I'm gonna cheat a bit. I'm gonna leave the ultimate decision up to you. So if you think that the impact of the pandemic is short and minimal, then maybe you could go to the smaller and cheaper banks. But if you think that the pandemic would last longer and the impact would be bigger, then maybe you prefer the bigger and safer banks, like BDO and BPI.